So let's now just talk about shorting shares, because I just want you to go through this. If you're doing spread betting, this doesn't really matter to you. And if you're doing options, if you're going to buy deep in the money puts, this doesn't matter to you. But if you're going to short shares, this does matter to you. And the things may change as time goes by. But at the moment, with most brokers, you will need 30% on margin if you're going to do an intraday trade. That means if you're going to open and close a trade during the course of one day. If you are going to stay in a trade for more than that one day and go overnight, maybe more than one day or two or three or more, you would need 50% on margin. Now, what is margin? Well, margin is cash or stocks equivalent, so it's basically collateral. So if you were going to do an intraday trade, you would need 30% multiplied by the stock price multiplied by how many shares you're selling short. If you were going to trade an overnight or more than intraday, so if you're going to hang on to this short trade for a while, you would need 50% multiplied by the stock price you're shorting at, multiplied by the number of shares you're selling short. We'll go through an example right now. The stock price is 22. Now, if you want to short this share, but you only want $1,000 maximum margin overnight, then here's what you would do. You take that $1,000, that's your maximum margin that you're risking overnight, you divide it by the stock price, and then you divide it by 50%. And that would give you the ability to short 90 shares overnight. And your margin risk on that trade would only be $1,000 or just a bit under. It would actually be 990, as you'll see in a moment. But what this is margin is required by your broker to mitigate the risk of shorting shares. We will go through shorting in more detail a bit later on in the brokerage section, but really it's quite simple. Your broker simply requires collateral, because if the stock price were to go to a million zillion, which obviously it's not going to do, but if it were to literally jump out of the sky and you've shorted shares, then there is a massive contingent risk. Now, in practical terms, this isn't going to happen because we're only going to be shorting when we've got bear flags that break out and there's no news ahead. So we mitigate our risk massively with that. It's just not going to happen. But your broker just requires that collateral, and that collateral is in the form of cash or stocks. Now, marginable stocks are stocks typically above $5, but different brokers will have different rules on that. So let's just revise this example again. We've had the stock price at 22. We wanted to have only $1,000 maximum margin overnight, so that gave us the ability to short 90 shares. We took the $1,000 of risk we were prepared to take, or the $1,000 of margin we were prepared to take, divided it by the stock price, and then divided it again by the 50% margin requirement, and that gave us 90 shares. So 50% times 90 multiplied again by 22, which is the stock price, equals $990 margin that's required for overnight trading, shorting this share at $22. So as you can see, we didn't even get to the $1,000 of maximum margin. What we got was 990, because if we were to short 91 shares, then that would take us just over that 1,000 threshold. But by shorting only 90 shares, then we're just below that $1,000 that we were prepared to have as margin overnight. As I was just saying, it's important to remember that the way that we trade, using flags and breakouts, and in the context of shorting, we'd be doing bear flags and breakouts from those bear flags and making sure that news is also not ahead of us, which could cause a surprise that could work adversely against us. It's almost inconceivable trading our way that we could ever lose that margin or put it under severe risk. Our measure of practical risk is a far better measure of your true risk, but your broker won't see it that way. Your broker will be a lot more conservative. Your broker's thinking for himself, and not everyone in the world trades our way. So a lot of people trade in a far riskier way. So they have to cope with all types of traders out there, and they are there to look after their own books. So it's a good thing, really, that they have this, but in our world, we will never, ever risk the margin requirements that they impose on us, and that's a good thing. Let's now take a look at the bear flag falling wedge again, and we know that we wouldn't trade one of these because there's no clear entry point. It's basically drifting down in the context of a downward thrust and context of potentially a downward trend, and we just don't have a clear entry point there. We don't also have a point where we can put our stop loss logically. It's impossible to trade these things with any kind of control, therefore we don't do them. That's why we've got the unhappy face there. Let's now look at one of the most important parts of trading, which is how to take profits.